All right. Welcome, everyone. We're talking about removing the jargon from ESG today. I'm Bob DiPasquale from Initiate Impact, and I have my friend here, Gabe from Your Stake, one of the co-founders over there. And we're going to be talking a little bit about some of the jargon and maybe some actionable items and steps and reasons why that we should consider values-based or ESG investing in our portfolios. Gabe, thanks for taking the time today. How are you doing?
Love it. I'm doing great. It's a nice Friday, and I can't wait to have this conversation. I think it's really timely and have a lot to say. So excited to dive in with you.
Awesome.
It's also my first LinkedIn Live, so I'm excited to explore this new platform, see how it goes.
All right, man. Well, so I've had a handful of LinkedIn Lives. I hadn't had one in probably 6 months until yesterday. So I just got warmed up and we're ready to go. I love the platform. I know we got some listeners and some viewers out there. So we'll dive right in. And I'm glad you have a lot to say because, I think there's a little bit of confusion out there. There's a lot of people who are trying to do well with their financial resources and invest in places that are meaningful to them and in companies that are doing a good job supporting what is meaningful. And so I wanted to start off by touching on some of those terms that are out there for anyone who, maybe it's like, okay, what's the difference between ESG and values-based investing or SRI and those different terms? So maybe we can start at the very top. Your Stake, you guys are heavily involved in helping people and advisors break down some of these terms and also find investments that are focused on them. So we'll start with ESG. What does ESG mean to you? Employee social governance. Excuse me, I can't even pronounce it. But what does it mean to you guys? And why are you in this business?
Sure. So I would love to start at the high level, and then we can dive into the very specific terms. ESG is the popular term of today. There's going to probably articles every single day written about ESG investing. We've got the SEC proposal about ESG. More and more people using that as their primary term to describe the general field of values-based investing. Maybe I'll take a step back and talk a little bit about Your Stake and why we were founded and how that kind of relates to this. So my co-founder and I started Your Stake in 2019 because we realized that there was a lot of jargon, a lot of confusion, a lack of transparency, and a lack of the ability to really communicate and understand what's happening within the field of values-based investing. And ESG was the term of art then. It still is, but I think now that there's actually a lot of pushback on that term, and I personally think that we can use better words to describe what we're really talking about. So ESG, as it's used today, is really anything that has some sort of relation to environmental, social governance, non-financial factors, for whatever reason you care about. But I think that the better definition is a more precise and narrow definition, and the true definition of what it really should be. And ESG in its purest form is looking at the environmental, social, and governance factors that have correlations, empirical correlations with financial performance, with risk and return. So ESG is looking at which factors matter to which companies in which sectors. Is there going to be a mining company that has a major lawsuit because it has horrible worker safety practices? Is there a company that's going to be really exposed to regulation to cut back on climate or other environmental pollutions? Is there a company that has really poor governance structures and there's a lot of danger of implosion, right? That's what ESG is looking at from the risk perspective. There's also opportunity. Where is the world going from an ESG perspective? So I think that's really ESG, really linked to financial performance and return and risk. And then values is the broader term that I think really should be the umbrella all-encompassing term. And that's, Bob, what do you care about? What are the issues? Do you like pharmaceutical companies? Or are you anti-pharmaceutical company? Do you want to avoid guns? Do you want to invest more in workplace equality just based on your own values and how you want to express those values through the world? So I think that's the broader term there.
I hear what you're saying. I find that when we're working with families and we ask them what's important to them and what are the things that they care about the most, it can be very, very broad. I mean, it's such a personal thing on what's meaningful in your life. And environment, social, and governance are certainly issues that a lot of people care about. It's not necessarily the minimization or the minimizing of ESG, but it's that it's just not ultimately not broad enough. I mean, there's other values and other things that people really, really care about. So we prefer the term values-based investing as well. But what we find is that investors, they don't really care the term at all. They just care about what they care about, right?
Mm-hmm.
So
That's totally, yeah. I mean, people come up to advisors and they say they want to invest in companies that aren't destroying the planet, or they want to invest in alignment with their faith or something like that.
mm-hmm.
No one ever comes in and says, hey, ESG, although that is happening more and more because it's in the news so much. And
Mm-hmm.
we hear stories of clients coming to advisors saying, hey, what's this ESG stuff? And should I do it? Or what's the deal with that? But you're right that people walk around with values in their head. They don't walk around with an ESG score that they want to achieve.
Yeah, right. You don't, like, when you ask someone, it's, hey, tell me about yourself. What are you interested in? You don't say, well, what's your ESG score that's valid? That's really funny. Well, good. So I think what the connection is pretty meaningful for people on where they're putting the resources. But there's also a lot of data that states that you can also assist your performance, especially in the places that are meaningful to you, with good screening. But one of the problems, maybe, Gabe, is that there isn't some consensus on what should be measured or how companies should be reporting what it is, reporting their data. Like, what is the data that's most important to ESG and values-based investing? So where do we go from here?
Mm-hmm. Yeah, I think that's very good point. And I think that's true of just general financial analysis, right? Some investment analysts will look for profitability. Others will look for, I mean, you can look at whatever financial metrics you want to look at. And there's reasonable people will disagree on, hey, I think this is where the company's going. I like their business strategy. I think they're going to outperform. I like their numbers, their whatever it may be. That's the same with ESG, right? And that's why there is a lot of divergence in the traditional ESG scores. Is some people will look at one company that is producing climate solutions, right? And they'll say, hey, this is great. Someone else might say, hey, they have poor gender diversity. They don't have very good corporate governance. They have some issues with conflict minerals in their supply chain. They're not really disclosing that much. So it's kind of a question of, do you weight the business model or do you weight the operational impacts of the company or whatever it may be? So I think that there's going to continue to be a divergence in scores and opinions on what leads to kind of that risk and return side of things. But there's more and more empirical evidence, which is great, that's tying for specific industries. Here are the issues that matter the most. And there's an organization called SASB, the Sustainability Accounting Standards Board, that really leads in, here are the issues you should be looking at from a financial perspective based on the sector or the kind of operations that the company has. And then there's always going to be divergence from a values perspective. Like for me personally, I don't think a score makes that much sense for people looking at values-based investing, because I have to agree with the values of whoever's putting that score together. It's not about being an objective measure of risk and return. It's about, does this company align with who I am and what I care about? So a score doesn't really fit that framework super well. It's more about what's actually going on, what are the companies doing, what is the data, raw data say about them. So that's what we focus on a lot. Do you see a similar thing?
I do, but I want to point out, and then maybe this is me being more vulnerable than I should be as an advisor or someone who runs an advisory firm. It can be intimidating for advisors in that position because, like you said, people will come to you and say, "What is this ESG thing?" And it's almost like there's an expectation that there should be some uniform code, and there's not, and there's not an understanding, and the answer that people are looking for is usually not, well, it's whatever it is you want it to be. Usually it's the answer that they're looking for is an explanation of what it is and how it can benefit them. And so what we try to do is we try to focus on how the benefits specifically, and maybe not so much the inputs, right? They have to understand the reasons why you might implement ESG or values-based investing. Maybe look at some data, and then understand, how they can use it to help further their own personal desires and mission before we can even start describing on what it actually looks like. And good tools are helpful at that point. But if they don't understand what it is, then I don't think we're ever going to make it that far. And I believe personally that we do have a responsibility. And, there's a lot of discussion out there in our industry about the fiduciary standard and what we should truly be offering people. And for me, it feels like their values should be very, very high on the list on the work that we do. So we need to play, maybe this is not the right term, but we need to understand their values and help them make decisions based on that. So I think there's some fiduciary work to be involved there. And this LinkedIn Live event is certainly not investment advice. I should mention that. But what it is, I believe, is advice to people and advisors and investors alike, that there are ways to evaluate organizations based on what's meaningful to you and not just what's meaningful to them or the other, what's meaningful to the reporting agency or what's meaningful to the people who run the company. There are ways to evaluate it based on your own desires and your own values, which is important, right?
Mm-hmm. So I have a question for you, Bob.
Yeah.
Your day-to-day seems like a lot of times it is about removing the jargon from ESG, exactly what our title is, right?
Yes.
And people come in and they ask questions. Do you start out by defining terms? Do you start out by giving definitions, or do you kind of avoid the terms and you say, hey, let's forget about this stuff. Let's focus on what you care about and then see what we can do? What's your approach there?
Well, I think we define the terms as much as we can. So when someone asks what ESG is, they want to know what the acronym stands for. So we'll mention environmental, social, and governance issue. Corporate governance is important. But we also have to explain that those definitions and those things of meaning can be different. And so, as I mentioned before, I hesitate to say, okay, this is what ESG stands for, or this is what, and maybe we'll get into SRI and some of the other terms as well. These are what these things stand for and what they mean, or what the words are. But the meaning is truly going to come from you, Mr. or Mrs. Client. And so, to answer your question, I think we briefly address what is standard. We can all agree what ESG stands for, at least. So we address that, but we definitely stay away specifically from the terms. We don't tell anyone, well, you need to participate in ESG or you need to participate in SRI or a specific way of describing what the method is. I think what's more important is how are they going to address and chase after, attack, or consider what's most meaningful to them. And this goes, Gabe, I'm glad you brought this up, to everything, not just where their investable assets are. I mean, when you're talking about people, they have other resources that aren't invested in the stock market or the bond market. They have other resources, and the decisions that they make based on those resources are also important. And so we try, when it comes to taxes or when it comes to their business decisions, or maybe there's business transition or estate planning, all of these decisions also we have to apply these filters to. It just so happens that the vast majority of the conversation can be about investable assets, because that's about as tangible as you can get when it comes to investing in an organization. You can kind of feel, at least through some of the data. So I hope that answers your question. But I always stress to people that they really need to think about what is truly meaningful to them. And then we will help them and kind of guide them, develop a plan, an investment plan and an estate plan and a tax plan to help, live out those values, if you will.
That makes a lot of sense. And maybe we can go to the slide that has some of those definitions now, because I'd love to ask a follow-up. When you are talking to someone about what they care about, do you also have conversations about, I don't know, their theory of change, for example, or the way that they want to express those values? So, for example, two people can really care about climate, and or let's 3 people or 5 people, and they can all have different ways that they want to care about climate, right? One person can want to invest in climate solutions. Another person can want to avoid investing in companies that are the worst polluters and contributors to climate change. Other people might want to do tilts. Other people might want to invest in the worst actors and then push them to change. Other people might want to avoid the public markets entirely and invest in project finance on solar panels or crowdfunding or whatever. So do you also have those conversations about the way they want to express those values? And what do those look like?
Yeah, I'm really glad you asked this question too. You just kind of teed me up on this one. Uh, we almost exclusively have the conversations about how. I mean, we certainly do to
Mm,
address the why or the what, but the how is really um, that's the best work that we do, because that gives people an opportunity to tell stories and to have a better understanding. I mean, I believe that storytelling is the best form of, no matter what language it's in or what format, is the best form of communication known to man since the beginning of time, because it puts you in the shoes of people, it helps you feel what's going on. So I think the how is vitally important. Most people, if I ask them, what are the issues on Earth that are important to us, most will not simply say, well, I care about hunger and climate change, and then just stop talking. Most of them will elicit some story
mm,
that's meaningful to them, or why, and even if it's not a personal story, it's a story of someone else that they've heard, or some work that they saw. And so yes, we absolutely talk about how. And can you specifically address that in the exact investments that you choose? Maybe. But you also talked about some people address these issues more than just with their
mm,
investments, or equity investments. It could be, like you said, it could be crowdfunding, or you've heard the term venture philanthropy is getting more popular too now. People investing, specifically in the medical field a lot, but they're also investing in causes, and they're not necessarily looking for an investment return. They're looking for impact. And we focus a lot on that in our firm as well. Don't get me wrong; we need to do the reporting and understand their investment returns. But how are they measuring their impact? And it's not always
mm.
by the dollars. A lot of times, it's by how the work that they've done, or that they've felt, or the stories that have been told, that makes them feel like they're doing good with what they have.
Wow, that makes a lot of sense. And I, as a person that runs a reporting company, would be really curious to hear how you tell those stories outside of the public equity investment context. Is that something that you're, I guess, pulling from the organizations that people are affiliated with to be able to pull together those stories and present them?
Yeah, and it's not as scientific as numerical data, as you know. So someone who who runs a great organization doing a lot of reporting, it's certainly a different feel. And I'm a numbers guy myself, coming from my background, working for many years in the industry. But it really is about the stories. And one thing that you have to think about is, I mean, every organization wants to present themselves as best as they possibly can, right? So if you're going directly from the source to get the stories, obviously there's going to be a positive light. And that's why I always encourage people, as much as you can, and it's certainly not possible with all of every investment dollar that you have, to explore it, in person. But I always encourage people to participate. And data shows that if you participate in causes, whether it's a for-profit cause, or it's just, or it's an investment, or a nonprofit cause, a charitable endeavor, statistics show that you're more likely to give more time and more money to things that you're familiar with, and that you've participated in. So, answering your question, we try to tell the stories, and specifically that says, okay, this is what your dollars are doing, and putting names and faces. And if you have pictures and videos, I mean, that's awesome. And this probably, if you're an advisor out there, you're probably thinking, well, okay, I don't have time to be putting together a promotional video for the investments that I'm suggesting to my clients. But that's not what I'm suggesting. What I'm suggesting is that a lot of organizations now, I mean, if you think about it, almost every company has their own media arm nowadays, right? So there's ways to engage people with this. And if you're a firm out there that believes in values-based investing, or ESG, or any of the things that we talk about today, I'm telling you that the clients that you're going to attract are going to want to feel and hear those stories, and they're going to be okay spending valuable meeting time with you, talking about that stuff. And I've seen it. I know people. I mean, how many times, Gabe? For us, I know that 90+% of the meetings that we're doing with people are not dominated by numerical reports and projections. Much of them are dominated by, okay, what is the result of what happened? Or what are we hoping the result or will be with our next decision? So to put it in the investment context, it's okay, how did my investments do? It takes just a few seconds or moments to respond to that. And then if I implement these changes that you're recommending or that we need to decide on, what is the result going to be? And so that if you have documented words or videos or something that says this investment is going to produce this, it makes them much, much more interested in the process.
I love that and would love to dive into some stories too. And maybe we can just take this this list of definitions that our team put together and talk through. Hey, if you're talking to someone who is explicitly looking for ESG, or they want to avoid particular companies, or they want to invest more in particular companies, how you can tell the story of how that can help them on the risk and return side, of how that can help them create impact, how that can help them align with their values. So I'd love to kind of start maybe with negative screening, because I think that was the earliest form of values-based responsible investing. And that's actually how I got my start personally. So
I was going to ask you that. I was going to ask you how you got into this industry and working through it. And negative screening, like you said, has been around for quite a while, but there's been necessary adjustments and improvements and other things along the way. But negative screening is at least a good start, I guess. I don't know if that's the right way to word it, but it's the way to begin.
Sure. Yeah. So the negative screening that I was introduced to when I was a freshman in college, the fossil fuel divestment movement was really taking off across the U.S. And I was a climate activist. That was the main campaign going on. That was actually my an introduction into financial services in general, was as an activist trying to see, hey, can we push the Yale endowment to stop investing in the dirtiest fossil fuel companies? And what the theory of change is actually there's been a lot of divestment movements throughout history, which are negative screening. You avoid and stop and sell your investments in the companies that don't pass a certain moral or ethical criteria. And there's a lot of evidence actually that negative screening as part of a movement, as part of a divestment movement, has led to a lot of public signaling that has created policy change. So there's this paper that maybe we can share around a link afterwards, Stranded Assets in the Fossil Fuel Divestment Campaign. It looked at every divestment campaign throughout history, and a lot of them are famous, like South African apartheid, and then some of them are much more niche, but every single one of them had some policy impact. And the reason why is that negative screening is a really simple tool and strong way to be able to send a public signal. So for people that are looking to create impact with their investments, that's kind of the mechanism for change, is being part of that movement. And that really needs to be accompanied by a voice. So just selling some stocks doesn't do much, but if you're doing it loud and publicly, that's where it creates some change. And then we were also making the case and looking at negative screening from a financial performance perspective, and stranded assets is another thing that we looked at. Is, hey, there's a risk in being invested in companies that are poor ESG performers, because as the theory goes, there's a chance that they have a higher risk and they will produce lower returns. And negative screening is one strategy that some people take from that perspective as well. So would love to hear your thoughts on how you talk about negative screening. Obviously, it's a very simple move and a powerful one from an alignment perspective too. A lot of people just don't want to profit off of companies that don't align with their values, and that's a really strong motivator. But would love to hear your thoughts, and then we can dive into some of the other phases of ESG.
Sure. So, like you said, it's especially with powerful tools like your stake. It's very simple to negative screen. For the most part these days, you can identify things that you don't want to be involved in. Like you said, fossil fuels. It could be tobacco. A lot of people that we've worked with over the years have been against it. But there's a whole list of things, and you can simply use the proper tools and you can negative screen. The reason why I believe negative screening is not, I don't want to be negative on negative screening. I think it's necessary, and it's a great way to start. But I don't think it's ultimately enough, or what people are ultimately looking for. So we talk about it, but we generally don't use the word negative. We just say other things that you'd like to eliminate from your investment portfolio. And the reason why is this, because I think people are more empowered. We're getting into a little psychological stuff here, but I think people are more empowered to support things that are really meaningful to them than they are to avoid things that are not as meaningful, or well, maybe not as meaningful, things that bother them. And if you can get those things out of their portfolio, that's it. That's all the work that you need to do. They're happy. But when you start working in things that they want to be involved in, there's a progressive momentum that builds, and they want to be more involved in the process. So yeah, negative screening, absolutely important. But I think it's really, if you want to develop that deeper relationship with the people that you're working with, and instead of, when you call them to set up their, quarterly or their annual review meeting, and you're just going to do some basic rebalancing, that instead of them saying, okay, cool, I'm glad the investments are doing well, thank you. I don't really, maybe we don't even need to meet. If you want them to be excited about having meetings with you, it's when you start adding in other layers of opportunities. Instead of helping them avoid stuff, help them find exciting opportunities that they can use their resources to do good in the world. And I think that's really where those deep relationships with your clients develop.
Interesting. So would you classify that more as a positive screening, or do you use different terms when you're talking about that?
Yeah. So we don't typically use the words negative and positive intentionally. It's not that people wouldn't understand it, or we try to avoid it specifically. But we really like to use we really like to use words like support and develop and initiate, if you will. Judging, as you can see by the name of our firm,
that's a good one.
Impact. And it was pretty intentional with that. And the reason why is I think there's a lot of people out there who have a desire to do good. And like we said, it's easy to screen things out. And it's a little bit more complicated, I believe, to screen things in. But the 99% of the time, in my opinion, it's worth that extra effort. Because that's what people want to see. So yeah, we don't say, well, let's do some positive screening. We say, well, let's find some things that you can really do good with your resources, or what would you like to support, or where would you like to see more effort put, or where would you like to see change or advancement in society? And it just those are like empowering words that will hopefully help them initiate their impact.
That's really cool. So, I just add on the positive screening side. I think a lot of people think about this as investing in solutions, as a term I've heard, in addition to the what do you want to support, what do you want to invest in, what is it motivating and exciting to you. And I think a lot of times this can be very similar to thematic investing. So people want to invest more in clean energy companies, is a very simple and good example. Or they want to invest more in companies that have really, really strong diversity policies and practices as well. And that's something that people are seeking out. Again, which companies are doing this really well. And you were talking about stories. That's stories that they can tell their friends and family, and they're excited about, and they like to share that as well. Is here are the cool things that I'm.
Oh yeah, because instead of bringing to them an article about the FTX crypto collapse or the economic issues that are going on, which some people want to hear, and don't get me wrong, and we broadcast information like that too. But now you're bringing to them these positive stories, like, hey, look at this company that you're supporting, and they just won an award for diversity or something like it, and they're like, oh, I had something to do with that, and it gets them excited. I love it, as you can tell. That's why I'm in this business.
Yeah, well, would love to take that to the shareholder engagement and advocacy side of things, because one of the functionalities that we support on Your Stake, and we think is really important, is sharing stories of how the investment managers in a client's portfolio are actually pushing companies to improve on social, environmental, and governance issues. And that, in terms of my own personal journey, taking a step back to that. So while a student, in addition to working on this divestment negative screening, at the same time, we were working on trying to get the university to add solar panels to its roof. So maybe that's on the positive screening side. And then we looked at shareholder engagement too, and looked at the track record of success that fund managers have had in pushing companies to change. There's a huge range, but there's some academic literature. Again, we can put links in the description afterwards, that there's between an 18 and 60% success level when a fund manager or an investor or an asset owner asks a company to improve their social environmental governance performance. It actually happens. It leads to impact, and it leads to real positive change, and that leads to really great stories that can be shared. And one other really cool thing, there's another paper from Dimsum, Karakas, and Lee looking at shareholder engagement and the impact of shareholder engagement on financial performance. And successful shareholder engagement on ESG issues has a really strong correlation with financial outperformance of the company. And I don't remember the exact time frame, but in a period following that shareholder engagement, it actually does lead to generally a bump in stock price. So companies that improve their practices on these issues get rewarded financially. And then obviously the client really gets to, again, participate in that story of creating real impact.
Interesting. I love digging into the data, and the fact that these fund managers are having an impact is really cool. So no pressure on the fund managers out there, but you guys have a great responsibility as well, which is cool though. I think we all have, essentially we all have a stake in it, to use your company's namesake. I think it's interesting to me that there's each role in our industry, including the consumer, has a way of affecting change and what it is that we do. And the fund managers specifically are there to manage the dollars for their investors, right? And they have certain requirements that they need to do, and if they're following them well, and they're making change, I mean, that's a really, really positive sign to me. I'd love to see more data on that though, but it's interesting. So where do you feel, your role, Gabe? I mean, you and your co-founder and the other people at your stake, I mean, the work that you all are doing is interesting to me because you're helping such a broad array of people, but you're not connected directly as much to the investor. You're connected more to the advisor. So what's it like to have that, like that one step removed, but you're really still helping people have a really powerful impact because your data is giving them, the way I describe it is this: your data is giving them clarity. You're not telling them what's important, but you're giving them the data so that they can figure it out themselves.
I think that's a really great description. Thank you, Bob. And yes, we do work directly with advisors. We found that a lot of times when investors want to make these decisions involving their money, they can find data from some public source, but the advisor is the trusted place where they really want to actually make decisions instead of just explore things that are really interesting. And that's why the work that you're doing is so important and why we try to build tools to support that. And our goal at Your Stake is to provide, I would say, actionable data, because Jeff Gitterman is a mentor of mine, and he's got a quote: "All the data in the world doesn't help an advisor tell a story." You can have a huge dump of data, and that's really important, and we need more transparent data, but what do you do with it? You've so many things to worry about and think about, and we really try to provide that data and the tools to make it useful and actionable and actually motivate investors to align their investments with their values in a much better way, and also share the stories of the shareholder engagement or the other impact that they're able to create. So that's really our mission and what we try to do at Your Stake.
Shareholder engagement. When I first got into the industry, I didn't even know what that meant. But now it's such an important part, whether you're proxy voting for people or they're in funds or they're doing it themselves. I think understanding, what the companies that you're investing in are doing and how they run their businesses is really important. And the support of organizations like Your Stake. And this is, because there's so much information and so many investment options out there, it's an impossible job to do without that clarity. So appreciate that and appreciate the work that you're doing. So
Bob,
you mentioned, go ahead.
Oh, go for it.
I was going to say, you mentioned the articles that we can put links to, or maybe we can put in the comments there. But one of them stated about the difference between, it said, So the number of indicators that feed into the final ESG rating ranges from 38 for one rating to 282 for another. And this is a study. It's a Wall Street Journal article. Like I said, we can put it in the notes, but we're still a long way away from narrowing things down, I guess is what the data is saying. We've identified that it's important, but we haven't figured out exactly how to create uniformity. And I don't think it will ever be perfect, but the closer we can get to it, I think the easier it is and the less stressful it is for people to invest with their values.
Yeah, and we have almost 200 data points on your stake, and that's one of the main things that we really help with and people need help with. There's thousands of data. 200 seems low. I've seen other sources that have thousands of data points. What do you do with that? So a big part of that is we have a diagnostic tool to help advisors figure out what their clients care about and match them with the most relevant data points for that, while still having the ability to dive into whatever you want to care about. But yeah, that leads to a lot of confusion and a lot of like people throwing their hands up. There's just so much to think about, so many trade-offs. If you want to avoid animal testing, now you're not able to support development of drugs that can help in lower middle income countries, because pharmaceutical companies that are doing that are doing animal testing too. There's a lot of stuff to think about, and what we try to do is provide a lot of simplicity to clarify all of these different terms, all the different hows, all the different strategies, all the different values that people can have.
It's like you're pulling levers, and you pull one and it might tweak another one. Just that's what it has to be.
And advisors can be really successful, we found, in two ways. The first is, let's keep it simple. You care about these 3 to 5 things the most. Here's what we're going to focus on. We'll forget about everything else. That's what we're going to do. And here we'll report on it. We'll make sure you're aligned to it. It'll be nice and simple. And then other advisors are taking the opposite approach and leaning into, it's a whole world of data out there. There are going to be trade-offs. We want to focus on these issue areas, but I want you to be aware of what else is going on. And then we can pull those levers if you want and allow the client to dig in. And usually it's different types of clients that require different types of communication and levels of complexity.
Absolutely. I know that for sure. I know that when my business partner and I left our previous firm, we had such a large base of people that we were servicing that it was very challenging to be as customized as we would have liked to have been with everyone. So we had a more simple approach towards the end of our time there. And it was, okay, let's concentrate on the things that are absolutely most meaningful to you. And those things can change. Seasons of life can change. But for the most part, it was, for years, people would have the same concerns, and we would focus our decisions specifically on those things. Negative screening the ones, like we talked about earlier, the absolute, deal breakers, and then trying to focus on a couple other things that maybe were meaningful to them. And it worked well. I think it did really, really good for people. Now our models are, much different. We flipped it on our head. Instead of being a mile deep, let's say, a mile wide and an inch deep, we're a mile deep and an inch wide with a select few families. And it's a little bit different now. We can, what we're able to do is get, I hate to say get into the weeds. I know it's a cliche and it probably seems overwhelming, but it's really get into the finer details that excite and get we talked a little bit about it's a little bit of behavioral finance, really what it is. It's giving them a positive reason to be involved, and they want to go more in the deep. They want to get more details. And so the additional data points are helpful because that helps them get even more granular on the things that they want to support. And those discussions about those things are once again, about opportunities. So I'm glad you brought that up, though. There are so many data points that you can't, not everyone is going to be of primary importance. But the way I look at it is this: every additional piece of data we have gives us another opportunity to be as accurate as we can possibly be. So I'm sure those data points will probably keep growing as software gets better and as more reporting becomes more, consistent in other areas of the world, and other sectors of the market that have that can give better data for us. You know what I mean?
So speaking of your last firm, I actually think there are maybe 2 terms on this slide that we didn't fully cover.
Okay.
One is faith-based investing and the other is impact. And I think it would be great if you want to give a description, because I think you really exemplify the approach of impact investing and what you're doing right now. And I think that faith-based was a big part of what you did at the last firm too. So if you want to cover those. And I saw we got a question from the audience too that we can cover after that. That would be an amazing starting point.
Sure. Well, faith-based investing is basically adhering to the guidance of a particular faith that may have certain moral issues or things that someone of that faith might consider to be of utmost importance. And so I don't want to say it's easy, but it's usually pretty easy to identify those things. So if someone identifies, and it still applies to this day in our work now, if someone indicates that they are of a specific faith and there are certain things that they do not want to invest in that need to be negatively screened, or things that they want to invest in specifically that their faith believes strongly in, we will absolutely implement those. And so the way I look at it, faith-based investing is a more detailed definition of what you should or should not invest in based on your faith. And so, my company is not in the business of telling people which faith they should be of, but if they are of a specific faith and they want those values of that faith to be included in their portfolio, then we're absolutely prepared to do that. So that would be faith-based investing. And then impact investing, for us, the way that's another term I feel that is probably not as broad even as it should be. We believe that there's lots of ways that you can use your financial resources to create a positive impact in the world. Impact investing, specifically though, in today's world, generally refers to a type of investment where investment returns are not necessarily the primary driver of your decision making. There are opportunities for investment returns, but you could be supporting a specific organization or a specific cause in addition to that, and that's why you might choose that option and potentially, I don't want to say give up, but to potentially limit your returns a little bit because you would prefer to support a specific cause with your investments. But there's all different types of ways you can create a positive impact, like we're saying. Even in your more general values-based investing, we believe that initiate impact, that you can be making a positive impact with a well-screened investment choice by using a tool like your stake. You could also make an impact investment by investing in sustainable causes in another area of the world, and in businesses, a small business. We have some connections that we try to make. I read a paper the other day about the importance of connecting small businesses in developing countries with funding. And I know that's a way of impact investment that a lot of people are interested in, especially if you visited certain places in the world. We talked a little bit earlier about personal stories and participating in causes.
That was your background, right?
Yeah. And these are not, and let me be clear, these are not charitable organizations. That's certainly another way to make an impact. And we do a lot of that work too in specific philanthropic planning. But I'm talking about investing in small startup organizations in developing countries that just don't have funding, but they're doing great things in their local communities. And that's a great way to really feel your dollars, especially if you're the type of person that has the ability and to travel place and see a small business owner in a small country. It's actually kind of cool. It makes you feel like you're really doing something great. So impact investing is a very, very broad opportunity, in my opinion.
Love that. And we did get a question that was for you in particular.
Sure.
Qualitative versus quantitative when it comes to reporting on impact. Oh, there we go. I didn't realize that.
There you go.
That we could pull it up on the screen. Perfect.
Yes, and I appreciate that. I appreciate that question, Anthony. Yes, so I will say that a lot of a lot of what we've been talking about today is anecdotal, and that's why I believe I talk specifically about giving people an opportunity to actually participate in these causes. The quantitative data, though, I don't want to minimize it, and the work that Your Stake and other organizations are doing to have quantitative data is of importance. We don't want to anecdotally choose investments and not have any data to back it up. But in my experience, what I've learned is that people are moved and motivated by the stories and the so-called anecdotal data. And they're moved by the results and seeing what's happened by what has been done. And if that needs to be proven by data, that does need to be proven by data. But if I just, in my experience, if we just put the paper and the data in front of them, that doesn't get them excited. That doesn't get them feeling like they have an ability to make a difference. And I think part of the role of our firm, and I'm not saying every firm's role is this, but part of our role is to help empower people that want to be givers. They want to be generous people. If you look at my LinkedIn profile, you see I'm really focused on generosity. And I believe that can be done in a capitalistic society. So I believe part of our role is to also empower people that they have the ability to make an impact. And in order to do that, they need to understand the stories and see the so-called qualitative data instead of the quantitative. But that's a great question.
Yeah, I really like that question as well. I also think a lot of times quantitative data can be the starting point for a story. So some of our metrics on your stake are, hey, you're responsible for 57 fewer asthma attacks, or 813 more homes powered by clean energy, or you're taking 100% of the tobacco out of your portfolio. And we found that those numbers can lead to stories of what's actually going on. And we also try to provide detailed information of what's going on with specific companies. So we'll back up that asthma attack number by showing, here are the companies in your portfolio or in your benchmark portfolio or in your old portfolio, and we're switching to the proposed new portfolio. Here are the companies that are creating toxic air pollution. Here's where they're located. There we go. Here's where they're located. Being able to see, oh my gosh, I have this power plant in my backyard and I see it's creating this toxic air pollution, and that's leading to asthma attacks. That's something that connects the portfolio with the numbers, with the stories. And it's a huge thing that we really try to focus on to make the stories both qualitative and quantitative. Sometimes that can't happen, but that's something that we've seen can be a big motivator too.
Absolutely. I'm glad you brought that up too. We should be clear that a lot of times the quantitative data can actually start the conversation. And then get people understand, and not even just getting them, to be honest with you, it's getting myself and my colleague, my business partner, to understand it too, right? Because I wish I was a human database of all the impacts going on in the world, but I'm not. I need to see the data myself too. Mm-hmm. So the data really does, that's a great point, gets the conversation started. And then the qualitative things is what drives the emotion and drives the desire. And then ultimately on the back end, you can also use data to verify and do some reporting on how it's been going, And I always think about, those memes that you see out there on the internet, they're like, it's someone like, 12 months ago, like 40 pounds heavier. And it's like, this is how it was. And then they switch the picture and like, this is how it's going. Mm-hmm. That's like, I'm dying to have a meme of some kind of impact investment firm use a meme like that to show like the meaning behind their work, right? Like this is what it was like, and now if you look at the new data, this is how it's going, and the work that you're doing as an investor is really changing the world, which is cool.
Love that. And that's the most compelling story. That's how people use our tool. Here's where you are now and where you could be. Here's the world as it is. There's a famous way of storytelling, which is the world is broken, but there's like the hero's journey. The world is broken. Here's the state of things, but there can be a better way. That's really the type of thinking that we really try to inspire, is here's where things are. Here are the issues. Here's the misalignment. Here's where things can go in the future and where things can be better. Or you've already made that change and it's legit. It's real. It's not just a score. It's actual things going on.
I think it's terrific. I heard a quote a quote once. Follow a man that has a story to tell, as opposed to a man who likes to tell stories. And it hit me because you asked about some of the investors that we've worked with over the years, and without fail, the ones that are the most inspiring are the ones that have specific stories to tell, that they like proof, essentially social proof of what they've done or what their investments have done. And you work with a lot of humble people out there, right? And they don't always want to share. So I always encourage people to share about their experiences, whether it's just quantitative or if there's some kind of in-person story as well. But stories are such a powerful thing.
Love that. Do you know if we have any other questions?
No, I appreciate the question by Anthony, though. I'm glad we could answer a little bit for you, but love to have these discussions. I don't see any other ones down there.
Mm-hmm.
Awesome. Well, I have a question for you. Can
Sure.
I ask you a question?
Yeah, go for it.
So you're part of this industry that's still very, very young, right?
Mm-hmm.
So what would you say is most needed in the values-based investing world right now? Like, what's the next step or the next innovation that we need to move it forward?
It's a really good question. I'll take a second to think about that.
Yeah, go ahead. That's the next thing that comes to mind for me, because the more we talk about this, I think the more investors are interested in it. And once you start getting people interested in it, I don't know about you, but we have people coming into the virtual office now, since we're virtual,
Mm-hmm.
the more people that ask questions about it, the more like feeling I have that something needs to be pioneered. The better, like the more responsibility I feel to make it happen.
Yeah, I think the trend. So a couple thoughts on trends. The first is, I do think the industry is going through a full trend on personalization. And that's not just on values. That's also get the best financial plan based on your particular situation, understand your money mindset, everything, what's your purpose, everything that needs to happen. But more and more personalization on values as well. And I think where things are headed is that we've been getting more transparency on allowing people to understand what's in their portfolios.
Mm-hmm.
And I think in parallels to other situations, consumers, for example, with organic products or whatever it may be, there's more and more information about what is going on within your product. And then the next step after that is linkages to direct impact. So right now, what people can do really well, more and more, and this still doesn't happen that much, but this is, I think, what your stake excels at right now. What's going on in your portfolio and what's happening. And then in terms of where the industry is going and what we're building towards and what I think the next excitement is okay, I now know what's happening within my portfolio. I want to create impact. How can I connect my portfolio to these stories of impact and have a very direct tie to understanding exactly what's happening and where things could be? So that means that I think people need to have the conversations that you're having, honestly, Bob. I'll call you a pioneer in this, is that most of the time in our industry, people care about issues and they say, okay, you care about climate, here's a better climate thing, there you go. And they don't get into the hows or the theories of change or the understanding of the nuance between, do I want the negative screening or the thematic investing or the shareholder engagement? And I think that's happening at the margins. And that's I think, I don't know if it's necessarily a technology innovation, but I think that is where the field is heading. And I think that's the mindset change that's going to happen as people start to question, well, why am I invested in all this? Like, is it actually doing anything? And what are the different ways that can happen? So that's my beliefs on that. What are your thoughts?
Yeah, awesome. I love that answer. So the way I look at it is this: there's a good advisor always has to have their hand or their mind on three different things. And when I say advisor, I don't just mean financial advisor. I mean, it could be a business coach or a life coach. They got to have their hands on three different things. What has the performance been previously? What are the changes or things that can be done to be made? And then what is the desired result? Right? Like, you have to make those connections between the past, the present, and the future. And so I think I don't want to say perfected. I'll leave that up to you, but I don't think we've perfected the reporting, but I think we're really good, much better than we used to be at the reporting even a few years back. So we have a lot of data to determine what has been happening. And we're starting to do a really, really good job of speaking with people about the changes that they desire, right? And I think we're well on our way to doing a better job of that. And let me say, if you're an advisor, a financial advisor out there, or any other type of advisor, and maybe you're not used to having these conversations, or you haven't, or you feel that there may not be the time, or maybe you can't add that to your service model. I definitely understand that from a time and business perspective. I think the simple way to get started in that middle realm of the present, like what's meaningful now, like what are the changes that we want to make? I think the simple answer is why. Why do you want to make wise financial decisions? It's such a powerful question, in my opinion. And so that's a great start. Is that going to build out an entire value-based investing vertical in your business? No, but it's a really, really good start. And I think the answers that you'll get will start helping you build that out. And so the third thing after that would be, what are the desired results and how can we get there? And so my thoughts or hope is that in the near future, we'll start spending more time concentrating on being able to project or do a better job of even knowing what's even possible, because we have people come into once again the virtual office. We have people jump on our Google Meet at our firm, and they'll say, we'll go back and look at reporting. We'll say what's important to them, and they'll be like, I want to really, these causes are important to me. Thank you for having this conversation, but how can I actually help? What is it possible for me to do actually with my dollars or my time? And so there is some data, like you showed, that sheet that we showed earlier, but I would like to see that advanced more some way. And I don't know the answer to that. I'm definitely not a pioneer in that space, but I want to be able to make that connection for people. And if you haven't been able to tell with me, it's all about the motivation. And I think the more we can get that connection made or projection of what could really happen, I think the more motivated people are to do well with what they have.
Wow. Love that. Any final thoughts that you want to share? We're coming up on time.
So I love quotes, and another one popped into my head while you were talking. So I heard this one on a podcast a couple of weeks ago now, and I wrote it down, and it was, the cliche, the grass is always greener on the other side. Mm-hmm. Well, the person said, and I wish I can give you the attribution to who it was. I feel bad, but I didn't write. I got to go back and look and see who said it. But they said the grass isn't always greener on the other side. The grass is greener when you water it. And that one hit me because it tells me that we all have this ability. We don't need to change ourselves, or we're not incapable, or we don't need to go to another place to make a difference. We just got to lean into what it is that we already have. We have water. You have a hose. Just start watering. Use the resources you already have. You don't need to start a new business or win the lotto to make an impact with your investments. You just got to be a little bit wiser, and water it is what you have, and you can make a difference.
Wow. I love that quote. I think you actually mentioned that to me last week, and I'd brought that up with a friend as well when we spoke last week. So that's a really powerful one to stick with.
Cool, man.
Yeah, I really enjoyed this LinkedIn Live. Good first experience for me. And yeah, thank you so much for joining me in this conversation. I hope that this was helpful in clarifying some of the jargon. I did have one last thing that I wanted to end with, which you mentioned at least everyone can agree on what ESG means, environmental social governance. Mm-hmm. That's not the case with some of the other terms. So SRI, for example, can mean socially responsible investing. It can mean sustainable, responsible, and impact investing. Also heard SII used a ton of times to mean whatever you want it to be. So the title of this was something about removing the jargon from ESG. I think a big part of that is the acronyms, and what you're talking about is what do you actually care about? What is your goal? What's your how? Basic terms without the jargon, because otherwise we're just not speaking the same language.
Yeah, there are too many. I love a good acronym, by the way, but yes, there are absolutely too many acronyms out there. So thanks for pointing that out. So awesome. Well, it's been a great discussion, everyone out there. Thanks for joining. Gabe from Your Stake, appreciate your time. Bob DiPasquale from Initiate Impact signing off. Everyone have a good day, and let's all make an impact.